Let's go a second round here. Just a couple quick questions, if I may. I think we've established that the excessive speculation is probably 30 to 50% of the cost of a barrel of oil right now. And Mr. Geit indicated that if we'd pass comprehensive legislation, maybe like 6330, H.R. 6330, the Pump Act, we might be able to burst this bubble. And if we burst the bubble, there are concerns that it would have a devastating effect on the economy. Some people have expressed that interest. Mr. Masters, you didn't seem to think so. You think they'd just shift, and the amount is so small right now because it's 1%. But if it moved to 5%, because we really don't know how big it is because we don't have the information yet. CTFC has not provided that information. If it goes to 5%, if it is around 5%, would that change your thought? And is there some devastating effects we have to be careful of?
I think that to a certain extent, what we're talking about here with speculation, the right terminology really isn't a bubble. It's really more like a tumor, and it grows and grows and grows. And in this case, it's hurtful as it expands. So the time to act is before it gets any worse. And so, when you discover a tumor, you take it out immediately. And so I think that if we were to let this continue to go on further and further, there could be more unforeseen consequences on the economy.
Mr. Geit, did you want to comment on that? Or you don't think it would have much impact if we, 30 days, brought down these prices 30 to 50%, if we pass comprehensive legislation, have the CFCT closing swap loopholes?
There are obviously winners and losers.
Sure.
The losers are going to be the winners of the last 4 or 5 years. And the winners are going to be the consumers that are paying for gasoline up to their nose, the farmers. These are the people that are hurting, and hurting pretty badly. If oil prices are cut in half, that is not the end of the world. Actually, it will make most industries, the airlines will have a lot more opportunities, the manufacturers and everybody. So I think there are going to be benefits that clearly outweigh the cost. And for the pension funds and all the people that invested very heavily, it's still, as Mr. Master said, it's still a small percentage of total portfolio. And by definition, if oil prices go down $30 or $40, the stock market is going to go by thousands of points, and everybody will be happy. So at the end of the day, I think putting an end to the speculative bubble or tumor, as Mr. Master put it very eloquently, I think we should have done that a year ago. It's not too late, but we should do it as soon as possible.
Well, let me ask this then. If it's just been mentioning pension funds, so I've been circling in on that, but one major investment bank told the committee that 12.5% of their commodity investments were held by sovereign wealth funds. Yet the CFTC tells us they know of only one sovereign wealth fund investing in the futures market. Clearly there's a disconnect here with the information. Do you think it's important for the CFTC and Congress to have a clear view of the role of sovereign wealth funds in futures markets?
This is part of the recommendation. I said disclosure. The best thing is full disclosure. I mean, they have to break down exactly who are the largest holders are, what their positions are, and how much money they are making. So before they make this outrageous forecast for oil prices, we should know exactly how much do they have to gain by it.
Okay, let me ask everyone this question, if I may, and I'll end with this one. How much liquidity does the commodity market need to perform its price discovery and hedging function? How much liquidity is too much liquidity? Is the market drowning in liquidity with 70% of an open interest in oil is held by speculators? As Kyle, I think it was chart number 2. Kyle? Kyle, chart number 2, my testimony, where you see that 70% of that open interest liquidity. What is the right percentage it should be?
Well, the right percentage should be really discussed with the physical hedgers. These are the people who need to know some of these trades are going to be done principal to principal, and all you need is just an intermediary. This intermediary should not dictate the price, should not take physical possession, if you will. All they have, like a broker, is just put the buyer and the seller, but do not get in the middle to profit from the transaction. So, the airline, the oil companies, and all these people can sit down and say, okay, how much liquidity in the system we need to have an efficient market? So I don't believe it's going to be a double or triple the physical market. I would venture to say it's going to be less than 20% of the physical market.
Less than 20? Anyone else care to comment?
Yes.
Mr. Dewan?
Yes, I remember when I started working with Ed a few years ago that actually we had a very liquid market and we had exactly the same problems. So I would be really careful here about saying that we do not need any of the financial on the market. I think that will be a tremendous unintended consequence to the market. What we need is to have position limits and everybody buy them no matter which window or which door they come into the market. Then everybody has a playing field and we know what's going on. But banning certain type of players or limiting as a percentage of the market, I don't think it makes a lot of sense because then you'll have a two-tiered market.
Well, the market always needs speculators, doesn't it? I mean, when oil was at a reasonable price, let's say $40 a barrel, $8 to $9 was probably the speculator's fee or the risk premium, wherever you want to call it. Now we're at $65 to $70.
Correct, but if you go see the pension fund, they tell you we're not speculating, we're hedging a part of our portfolio. So it really depends where you sit.
And what business interest is a pension fund hedging against?
Well, it's hedging against a declining dollar. They hold huge assets in dollar, which are declining in value, so they're protecting.
Sure. But isn't the exception supposed to be for a bona fide exception, not speculation or hedging on the cost of the dollar, but rather the airline industry or trucking industry who really needs that hedge?
Well, if you have a pension fund and the value of the stocks you're owning are going down, you're not going to be very particularly impressed by the manager of your pension fund, and you want him to do something about it. And the one thing he discovered how to do over the last 2 years is to hedge part of his portfolio on other commodities which are rising as the dollar decline. Gold is one, oil is another one, et cetera, et cetera.
Sure.
My point is about the unintended consequence that Ed was talking about. If you reduce the market, you have other unintended consequences. Finally, about the liquidity issue, I don't know if you have 71% of speculators here in the market, it means that it's more liquid. I could say it's probably less liquid because a lot of the players are coming only on one side of the market. Actually, what you have here is a lack of liquidity. You have a lot of buyers, you don't have a lot of sellers. And the question is, how do you rebalance that? How do you make these pension funds being willing to play both sides of the curve, not only one side? So I don't think we're struggling through too much liquidity. I think we're struggling too little liquidity.
Mr. Masters, Mr. Craples, anyone care to comment?
Sure. So the issue with pension funds trying to hedge, I mean, that whole issue, I mean, pension funds are capital markets investors, and they are looking at the commodity. They're trying to look at the commodity markets as a place for buying and holding. You know, the whole concepts, buy and hold, long term, we're investors, don't apply to the commodity futures markets. These are capital market concepts. They're not commodity futures concepts. Commodity futures expire, in some cases monthly. The reason they expire monthly is because they have a physical delivery functionality that allows physical delivery participants to theoretically take delivery. That's why they expire. So the way pension funds do this is they buy a futures contract, and then they sell when it gets ready to expire, and they exchange it for another contract. So effectively what it is, it's like a layaway in the commodity futures markets. They never actually take delivery. So there's other ways that they could hedge inflation, or there's other ways that they can make a bet against the dollar. But certainly, if they're involved in the commodities futures markets, let's have them involved in a strategy. You know, give the money to a CTA, give the money to a CPO. But let's have them involved in a buying and selling strategy rather than a one-way, long-only allocation strategy. And if they do that, let's make sure that they and every other participant in the futures market abides by very strict position limits.
May I only add that futures markets are incredibly valuable parts of our economy. We do not want the oil futures markets to go away. They need more than 20% speculation to survive. They need multiples of the physical markets trading to survive. What we have here is a matter of degree. The markets in the last couple of years have just become excessively the home of the speculation that Mr. Masters has talked about. We do not want to regulate the futures market out of existence. We want to regulate it back to the point where it was in the 1990s, which was an excellent, excellent market for hedgers.